Most traders lose money because they think they are buying weakness. In reality, they are buying noise. That sounds strange at first, doesn't it? Because you've probably been taught that a pullback is an opportunity. Price drops, RSI cools down, you buy the dip, simple, clean, efficient. But markets have a habit of punishing ideas that become too simple. The 10 RSI pullback entry is not about chasing a discount. It is not about seeing red candles and assuming value suddenly appeared. The market does not hand out bargains because you want them. The market reveals behavior, and behavior leaves clues. The question is, are you reading the clues, or are you reading your own hopes? Watch traders long enough and you'll see something interesting. Price runs hard. Momentum explodes. Everybody feels late. Then price finally pulls back and suddenly people feel relief. Good. Now I can get in. But why do they feel relief? Think about it. Nothing improved. The business didn't suddenly change. The market structure didn't become safer. The trend didn't become stronger. The only thing that changed was emotion. Price came closer to where people wished they had entered. That difference matters, because many traders are not entering based on strength. They are entering based on emotional comfort, and emotional comfort is expensive. The market rewards discipline far more than comfort. Now let's talk about what you're actually observing with the 10 RSI pullback entry. Imagine a stock trading around $10. It pushes aggressively upward. Volume expands. Buyers are active. RSI moves into stronger territory. Energy enters the market. Then something changes. Price begins pulling back. Now most people immediately divide themselves into two groups. One group panics. It's over. The other group becomes reckless. Perfect. Cheap shares. Both groups are making assumptions. But assumptions are dangerous because they remove observation. So instead, ask yourself something different. What kind of pullback am I looking at? Because not all pullbacks carry the same message. Some pullbacks represent exhaustion. Others represent digestion. One ends a move. The other prepares for another move. And if you confuse the two, the market extracts tuition from your account. Have you ever entered a trade because RSI reached some magical number? Maybe 35. Maybe 40. Maybe 30. You saw the indicator touch your level and immediately pressed buy. Then price kept falling. Why? Because RSI by itself tells you pressure changed. It does not tell you who is in control. That's a critical distinction. Pressure and control are not identical. Think of it this way. Imagine a strong runner slowing down after a sprint. Breathing becomes heavier. Pace decreases. Does that mean the runner collapsed? Not necessarily. It might simply mean recovery is taking place before another push. Markets behave similarly. The RSI pullback works best when strength pauses without surrendering control. Read that again mentally. Strength pauses without surrendering control. Because the pullback itself isn't the signal. The behavior around the pullback is the signal. Now you're probably asking, what does that actually look like? Look at price before you look at RSI. That's where many people reverse the process. Price first, indicator second. Let's say your $10 stock rallies from $8 to $10 with conviction. Strong candles, strong participation. Then price begins pulling back toward $9.50 or $9.40. What are you watching? Are sellers suddenly aggressive? Are candles expanding downward? Is volume exploding during the decline? Or is the opposite happening? Maybe candles become smaller. Maybe volume shrinks. Maybe selling pressure starts looking hesitant. Now something interesting begins developing. The market starts whispering, not loudly, quietly. Aggressive buying created the move upward. Passive selling created the pullback. That imbalance matters because markets tend to continue what required effort while correcting with less effort. Cause and effect. Strong buying creates momentum. Weak selling creates a pause. A pause creates opportunity, but only if the conditions remain intact. Do you see why traders struggle? They want certainty. They want a formula. RSI hits 42. Buy. RSI hits 38. Buy. Markets don't operate with that kind of obedience. Human behavior is too messy. People are emotional. Institutions are strategic. Crowds are impatient. And price becomes the result of all of that mixed together. So when you study a 10 RSI pullback entry, you're not studying numbers. You're studying behavior wearing numbers as a disguise. Now let's move into application. You sit down before the market opens. You already identified stocks showing real strength, not random movement. Strength, there's a difference. Strong relative movement, clean upward structure, anticipation, interest, then price pulls back, RSI cools down. You wait, and this is where most people become uncomfortable. Because waiting feels inactive. Waiting feels like doing nothing. But waiting is observation. And observation creates information. Ask yourself, is the pullback orderly? Is support being respected? Is selling becoming weaker? Is price holding where stronger buyers previously entered? Questions like these slow you down. And slowing down matters because impulsive decisions often arrive wearing the mask of confidence. Many traders aren't confident. They're urgent. Urgency and confidence look similar at first, but urgency wants action immediately. Confidence waits. Now consider another mistake. People see RSI pull back and assume they must catch the exact bottom. Why? Why this obsession with perfection? The market does not pay you for precision. The market pays you for positioning. You don't need the lowest price. You need a price where probability begins leaning in your direction. There's a difference. Suppose your stock pulls back from $10 to $9.45. You wait for signs of demand returning. Maybe price stabilizes. Maybe volume increases slightly. Maybe buyers begin reclaiming small areas. You're not buying because RSI touched a number. You're buying because behavior suggests the pause may be ending. See how different that feels. Now the trade becomes less about prediction and more about participation. Prediction says, I know what happens next. Participation says, I see conditions shifting. One approach feeds ego, the other protects capital. And over time, protecting capital matters more than being right, because traders who survive long enough eventually discover something strange. The largest opportunities rarely feel exciting in the moment. They often feel ordinary, quiet pullback, controlled behavior, patience, entry. Nothing dramatic, nothing heroic, just a repeated process. And when you begin seeing these patterns repeatedly, another question starts appearing in your mind. Most traders believe that if price pulls back, strength is disappearing. They see a few red candles and immediately assume control has changed hands. That reaction is common because the eye naturally focuses on movement. Price drops, emotion reacts. But the market often hides important information inside these small movements, and if you only look at the surface, you'll miss what is actually happening underneath. Think about this for a moment. Does every step backward mean defeat? If a strong athlete slows down after a hard sprint, do you immediately assume the race is over? Of course not. Sometimes the body is simply adjusting before another effort begins. Markets can behave the same way. Price pulling back and control changing are not the same event. Many traders treat them as if they are identical, and that confusion becomes expensive. Price is movement. Control is influence. Movement can change temporarily while influence remains exactly where it was before. Watch a stock that moves from $8 to $10 with strong participation. Buyers are active. Momentum expands. Interest enters the market. Everything looks powerful. Then suddenly price drops to $9.70, then $9.50, maybe even $9.40. Immediately people become uncomfortable. Here we go. It's reversing. I knew I missed the move. But ask yourself a different question. Who is actually controlling the market at this moment? Because lower prices alone don't answer that question. Look closely at how price is falling. Are red candles becoming aggressive? Is selling volume exploding? Are buyers disappearing completely? Or are candles becoming smaller? Is selling pressure losing energy? Is the decline moving with hesitation instead of force? This matters because markets leave footprints. Strong buying usually leaves evidence. Weak selling leaves evidence too. A healthy pullback often looks different from a real breakdown. A healthy pullback may drift lower slowly. Price pauses more often. Selling appears less committed. It almost feels as if the market is exhaling after effort. That is an important observation because cause creates effect. Aggressive buyers push price upward. After a strong move, short-term traders take profits. Some late buyers become nervous. Small selling enters the market. Price pulls back. But if larger participants still maintain interest, control remains where it was before. The market can move lower while underlying strength remains intact. This is where many traders lose their position. They focus on temporary movement instead of underlying behavior. Fear appears because they assume every decline means danger. But experienced traders understand something important. Control usually leaves before price reveals it clearly. By the time complete weakness becomes obvious, much of the move has already happened. That means your job is not simply to watch where price goes. Your job is to watch how price behaves while it gets there. Price can pull back. Control can stay exactly where it is. Many traders look at RSI as if it gives direct instructions. The number reaches a certain level, and suddenly they feel they have received permission to act. RSI drops below 40, buy. RSI reaches 30, buy harder. RSI rises above 70, sell. Simple rules feel comfortable because they remove uncertainty. But markets have a habit of punishing blind comfort. Ask yourself something. Have you ever bought a stock simply because RSI looked oversold, only to watch price continue falling? Or maybe you sold because RSI looked too high, and then price kept climbing without you. Why does that happen? Because RSI measures pressure. It does not measure authority. That difference seems small, but it changes the way you read the market. Think of pressure like speed on a highway. A car can slow down. Speed decreases. But slowing down does not automatically mean the driver lost control of the vehicle. The driver may simply be adjusting before accelerating again. RSI works in a similar way. When RSI begins falling, it tells you momentum is cooling. It tells you that buying pressure is changing. But it does not automatically tell you that sellers now own the market. Too many traders assume control changed because pressure changed. That assumption creates poor decisions. Imagine a stock moving aggressively from $8 to $10. Strong candles appear. Volume increases. Buyers are clearly active. RSI climbs with the move because momentum is strong. Then price starts pulling back. RSI begins falling from higher levels. Maybe it drops from 75 to 60. Maybe from 60 to 50. Now watch what many traders do. They stare directly at the indicator. They become obsessed with the number itself. It's losing strength. Momentum is dying. But the market asks a different question. Who is actually in charge? Because pressure can decrease while control remains untouched. A strong trend does not move vertically forever. Markets need room to breathe. Buyers take profits. Short-term traders leave. Some participants become uncertain. Momentum cools. RSI reflects this cooling process. But cooling is not the same as surrender. That distinction matters because if you confuse the two, you start reacting to information that was never intended to give complete answers. Indicators were built to support observation, not replace it. Price still comes first. Structure still comes first. Behavior still comes first. RSI becomes useful when you place it beside market action instead of above it. Suppose price pulls back and RSI drops toward lower levels. Now instead of immediately buying or selling, observe what price itself is doing. Is selling becoming aggressive? Are support areas breaking apart? Are candles expanding lower with force? Or does price simply appear to be resting? Maybe candles shrink. Maybe selling slows down. Maybe price starts stabilizing. Now RSI is telling a more useful story because context exists around it. Without context, numbers become dangerous. RSI can tell you pressure changed. It cannot tell you who owns the field. Most traders see price moving lower and immediately place everything into one category: weakness. Red candles appear, momentum slows, and assumptions begin forming almost instantly. The mind wants speed. It wants fast answers. Price falls, so strength must be disappearing. But markets are rarely that simple. Ask yourself something. Have you ever watched a strong stock pause for a while, only to see it continue climbing afterward? And on the other side, have you seen a stock look cheap after dropping, only to watch it sink even further? Both situations involve price moving lower, but they are not the same thing. One is weakness, the other is rest. If you fail to recognize the difference, you begin reacting to movement instead of understanding behavior. Think about a machine running at full speed. If it operates continuously without pause, pressure builds, heat builds, stress builds. Eventually performance suffers. Strong systems often require brief periods of adjustment before they can continue efficiently. Markets behave in similar ways. A stock cannot move upward aggressively forever. Momentum creates energy, but it also creates temporary imbalance. Traders who entered early take profits. Late buyers hesitate. Short-term participants exit positions. Price slows down. That slowing process can look uncomfortable if you only focus on surface movement. This is where many traders become trapped. They believe every pullback means the trend is weakening. Fear enters quickly because they assume movement and meaning are identical. But movement and meaning are often separated. A stock can pull back while remaining healthy. A stock can also pull back because larger buyers are leaving. Your job is to understand which one is taking place. So what should you actually watch? Start with the character of the pullback. Weakness often carries urgency. Price falls aggressively. Selling pressure expands. Red candles grow larger. Volume increases as participants rush toward exits. You can feel the change in behavior. Selling becomes committed. The market suddenly looks heavier. Rest usually behaves differently. Price may drift lower instead of collapsing. Candles often become smaller. Selling pressure can lose intensity. Volume may shrink as activity slows down. The market almost appears quieter. That quiet behavior matters because cause creates effect. Strong selling creates fear. Fear creates urgency. Urgency creates disorder. But when price simply rests, the market often behaves with more balance. Think of a runner after a long sprint. Heavy breathing does not necessarily mean the race ended. It can simply mean preparation for another effort. The mistake happens when people assume fatigue automatically means failure. Markets create the same illusion. People become emotional because they dislike uncertainty. They want immediate answers. So they label every decline as danger or every dip as opportunity. Both reactions can become expensive because weakness removes strength. Rest preserves it. And the difference usually reveals itself through behavior rather than price alone. Most traders spend too much time looking at where price moved and too little time asking how it moved. They see a stock climb quickly, then pull back slightly, and they focus only on the distance traveled. Up $2, down 50 cents, up another $1. But numbers alone rarely tell the whole story. The market is not only about direction, it is also about effort. Ask yourself this. Have you ever seen a stock rise aggressively and then pull back slowly, almost as if it had lost interest in falling? It drops, but something feels different. The move downward lacks force. The candles look softer. Selling appears weaker than expected. That difference matters, because not every move carries equal conviction. Imagine two people trying to push a heavy object. One person pushes with strength and intention. The object moves quickly. The other person barely applies effort, and movement becomes small and slow. The object moved in both situations, but the force behind the movement was completely different. Markets work the same way. Strong buying leaves fingerprints. Weak selling leaves fingerprints too. Suppose a stock moves from $8 to $10 with large candles and increasing volume. Buyers are active. Participation expands. Price rises with purpose. Now the stock pulls back. Most traders immediately focus on one thing. It's dropping. But stop there for a moment. Dropping is not the important question. The important question is this: how hard is the market working to create that drop? Because effort reveals information. If price moved $2 upward with strong participation, but only pulls back 30 or 40 cents with weak participation, something important may be happening beneath the surface. Buyers needed commitment to create the upward move. Sellers are creating the pullback with much less effort. Because creates effect. Strong effort often creates stronger movement. Weak effort often creates temporary movement. This is why some pullbacks feel dangerous while others feel controlled. Danger usually arrives with aggression. Selling expands. Volume increases. Price falls with speed. Participants rush toward exits. Control begins shifting. But weak selling often looks different. Price drifts lower. Candles become smaller. Momentum slows. Selling lacks urgency. The market starts behaving more like a pause than a battle. Now think about what this means psychologically. Many traders react emotionally whenever they see red candles. They see downward movement and immediately assume something negative is developing. Fear creates fast conclusions. Fast conclusions create poor decisions. But experienced traders learn to separate movement from commitment. Because selling exists in every market. The important question is whether sellers are actually taking control or simply creating temporary pressure. Strong buying can create trends. Weak selling can create opportunities. And if buying required real effort, while selling barely seems interested, the market may be revealing more than most people realize. The imbalance matters. Most traders think they make decisions based on logic. They study charts, watch indicators, and tell themselves they are acting with discipline. But if you observe closely, you begin noticing something different. Many decisions are not driven by logic at all. They are driven by comfort. And comfort can become expensive. Ask yourself something. Have you ever watched a stock run upward without you, felt frustration building inside, and then suddenly felt relief when price finally pulled back? That feeling is familiar. Price drops and the mind immediately says, "Good, now I have another chance." But think carefully about what actually changed. Did the company improve in the last 10 minutes? Did market structure suddenly become stronger? Did new information appear? Usually not. The only thing that changed was how you felt. Price moved closer to where you wished you had entered. That difference matters because traders often confuse emotional comfort with opportunity. The market does not care where you wanted to buy. The market does not know where you feel comfortable. The market only reflects behavior. Yet many traders build decisions around reducing emotional discomfort. They hesitate while a stock shows strength because they fear buying too high. Then they wait for a pullback because it feels safer. Notice the language. Feels safer. Not is safer. Feels safer. Those two things can be very different, because emotional comfort creates an illusion. It tells you that lower prices automatically mean lower risk, but lower prices by themselves tell you almost nothing. A stock can drop because strong buyers are taking a brief pause. A stock can also drop because larger participants are leaving quietly. The chart may look similar at first, but behavior underneath can be completely different. This is where expensive mistakes begin forming. Suppose a stock rises from $8 to $10 with strong momentum. You hesitate because you think price moved too far already. You tell yourself to wait. Then price pulls back to $9.50. Suddenly confidence appears. Now you're ready. But ask yourself why. Did evidence improve? Or did anxiety simply decrease? Because many traders don't buy strength. They buy relief. Relief feels good because it removes the fear of being late. Relief says, now I can enter without feeling foolish. But the market rarely rewards decisions made purely for emotional comfort, because creates effect. Fear of missing out creates hesitation. Hesitation creates frustration. Frustration creates emotional decision-making. Emotional decision-making creates poor positioning. This cycle repeats because people naturally seek psychological ease. Human beings avoid discomfort. Markets often demand it. Sometimes strength feels uncomfortable because price already moved. Sometimes patience feels uncomfortable because action seems easier. Sometimes waiting feels uncomfortable because uncertainty exists. But comfort itself cannot become your signal. Because comfort often appears exactly where discipline disappears. Emotional comfort feels safe. The market does not measure feelings. Most traders pay attention when the market is moving fast. Strong green candles appear and excitement increases. Sharp red candles appear and fear follows immediately. Fast movement attracts attention because speed creates emotion. But some of the most useful information in trading does not appear during the move itself. It appears during stress. Ask yourself something. When do you learn more about a person? When everything is going well, or when pressure arrives? Most people reveal their real character when conditions become difficult. Markets do the same thing. Strong trends look impressive while price keeps rising. Almost everything appears healthy when momentum is pushing upward. Confidence becomes easy. Buying feels easy. Decisions feel easy. But the real test often begins when price stops moving smoothly. That is where the pullback starts speaking, because pullbacks place pressure on everyone involved. Buyers who entered late become nervous. Short-term traders begin taking profits. People watching from the sidelines start questioning whether they missed the move or avoided a disaster. Stress enters the market, and stress changes behavior. This is why pullbacks reveal important information. They force participants to react. Those reactions create clues. Suppose a stock moves strongly from $8 to $10. Momentum is healthy and buyers clearly control the direction. Then price begins pulling back. Now watch carefully. Not where price goes, how it behaves. Does selling suddenly become aggressive? Do candles expand lower with force? Does volume increase sharply? Does price slice through important areas without resistance? Or does something else happen? Maybe price drifts lower slowly. Maybe candles become smaller. Maybe volume begins fading. Maybe buyers quietly start supporting the stock at certain levels. The market is now under stress, and behavior starts revealing what exists underneath the surface. Because stress exposes strength, it also exposes weakness, because creates effect. If larger buyers still believe in the move, selling pressure may struggle to gain momentum. Price can pull back, but support may continue appearing. If larger participants are leaving positions, the behavior often changes. Selling becomes heavier. Price reacts differently. Momentum shifts. The market starts revealing a different story. Many traders miss this because they become distracted by the fact that price moved lower. They see the result but ignore the process. The process matters. A pullback is not simply a decline on a chart. It is a moment where pressure enters the system and forces everyone to make decisions. Some participants panic. Some become impatient. Some step aside. Some defend positions. And all of that behavior leaves footprints. The pullback becomes a test. Stress begins asking questions the market cannot hide from. Most traders begin their analysis from the wrong place. They open a chart and immediately look at indicators. RSI, MACD, moving averages, oscillators. They search for a signal first and price second. The indicator becomes the leader, while the chart itself becomes secondary. That habit creates problems. Ask yourself something. If you wanted to understand what people are doing in a crowded room, would you watch the people directly, or would you stare at a report describing them from 5 minutes ago? The answer seems obvious. You would watch the people. Price works the same way. Because price is the actual behavior of the market. Indicators are calculations created from that behavior. They are reflections, not the original source. Yet many traders reverse the process. They see RSI reach a certain level and immediately become interested. They see a crossover and suddenly believe opportunity appeared. But indicators do not create movement. Price creates indicators. That distinction matters because every indicator is built from information that already happened. Think about it this way. Imagine standing in front of a lake. The reflection on the water shows what exists above it. The reflection can be useful. It can give information. But if you become obsessed with the reflection while ignoring the real object, confusion eventually appears. Indicators are reflections. Price is reality. Suppose a stock moves from $8 to $10 with strength. Buyers are active. Volume expands. Momentum builds. Then price starts pulling back. Many traders immediately look down at RSI. It's near 40. It's becoming oversold. Maybe this is the entry. But stop for a moment. Look at price first. What are the candles doing? How fast is the stock pulling back? Is selling becoming aggressive? Are important areas being respected? Does volume support what you're seeing? Because price itself starts answering questions before the indicator ever does. Maybe the stock pulls back slowly. Selling pressure appears weak. Price stabilizes near previous support. Now the RSI reading suddenly becomes more meaningful. Not because the number changed, because context changed. Without context, indicators become dangerous. A number by itself can create false confidence. People begin treating signals as commands instead of information. That creates emotional decisions because certainty feels attractive. The mind likes simple instructions. RSI reached this level, buy. RSI crossed that line, sell. No thinking required, but markets rarely reward blind obedience. Because creates effect. When traders rely too heavily on indicators, observation becomes weaker. Weak observation creates assumptions. Assumptions create poor timing. Poor timing creates frustration. Eventually people blame the indicator itself. But often the indicator was never the problem. The problem was placing the tool above the behavior it was built to measure. Price speaks first. Everything else follows behind it.